Hello, this video I'm going to teach how to use the Fibonacci Extension tool to set take profit levels. Before I go into the lesson, it's important to understand why it's necessary for you to use this Fibonacci Extension tool. So if you look at this market, we can clearly identify an uptrend. The market is forming higher highs and higher lows. So let's assume at this point here, after the market has retraced, let's assume we got our buy entry at this price level. So when you get our buy entry here, the question is, where do we set our take profit? So assuming you set your take profit at 45 pips, it was hit. If you set it at 8 pips, it was hit. If you put it at 120, it was still hit. And assuming you put your take profit at 140 pips, let's say, you see it was never hit. So now this is why we need to know the best zones, or rather the best levels, price levels, that you can set your take profit. And you can only do this in the best way using the Fibonacci extension tool. It will help you so that you are able to fully capitalize on the price move. At the same time, it will also help you to avoid being overambitious, because you see the guy who targeted profit level at this price point, price never got to that point. On the other hand, if you took your entry here and you targeted to exit at this point, yes, you hit your take profit, but after exiting, you missed a whole 77 pip move. So how do you know the best place to exit so that you are not too quick to close your trade, you're not too quick to exit, and you're also not too late to exit by overholding your position? Then after seeing large profits, the trade ends up reversing. So let's get into the lesson. The first thing to note is that you can only apply the Fibonacci extension tool in a trending market alone. So the market must either be in an uptrend or a downtrend. When you talk of an uptrend, we are talking of a market that is simply forming higher highs and higher lows. That's how an uptrend looks like. So we must have that series. That this is the only time that the Fibonacci extension tool is applicable. When you talk of a downtrend, we are simply talking of a market that has price forming lower lows and lower highs. So these are the only two times that you can apply the Fibonacci extension tool. Now, in any trending market, we have two types of moves. The first move is the impulse move. The second is the retracement. The impulse move, as you know, is the move that is to the direction of the trend. Then the retracement move is this counter move here. This is now the retracement. So when you're drawing your Fibonacci extension, the Fibonacci extension tool has 3 points. So you will use the previous impulse move to draw the Fibonacci extension. So I think it's going to get simpler when I go into the actual market and show a live example. So I'll start with an uptrend. First, I'll just start by marking the higher highs and higher lows to confirm that this price is in an uptrend. So as you can see, we have the impulse move and the retracement. So you just mark the higher highs and the higher lows to confirm that the market is indeed in an uptrend. So that can be confirmed as of now. So now let's get to our trade. So since the market is in a bullish trend, we are obviously looking for bullish trades. You're looking for bullish setups. So at this particular point here, there are several ways that you could have identified your bullish trade. For example, if you use your Fibonacci retracement from this to that point, remember the Fibonacci retracement only has 2 points. You can clearly see that this is the 50% level. So this is a good zone to look for a buy trade. And also after the 50% level, we had a small consolidation and a breakout, another consolidation, very tiny, and a breakout. So let's assume that at this particular point, we've now gotten into our buy trade there. So now the question is, where is the best exit point? Because we want to have an exit where we are not targeting very little pips. At the same time, we don't want to be very over ambitious and target too many pips where the price might never get to. So this is where you come and use your Fibonacci extension. The Fibonacci extension joins 3 points together, unlike the retracement. So the Fib extension has 3 points. So the similarity is that whenever you're doing the Fibonacci, you use the previous impulse move. So this is our entry point here. So the entry point doesn't really matter. What matters is that this is the previous impulse. The previous impulse is the direction to which price pushed, before we had the retracement. So we're going to check the Fibonacci extension tool, which is on your platform. You draw it from the previous impulse. So the previous impulse, you start with the previous higher low. And as you can see, the Fibonacci extension tool has several price zones. We have the 0.2, 0.3, 0.5, all these levels. So the question is, where do you exit your trade? So the best point to exit your trade using the Fibonacci extension level is usually anywhere between the zone 0.7 to 1. So let me just extend the Fibonacci to the right for you to see. So first of all, at 0.5, which is at this point, it simply means that price has now bought and it has covered at least it has covered at least half of the previous move, because the previous move was from this point to this. So at 0.5, because 0.5 is literally half, so it means that right now price has covered at least half of this previous move. And at the point 1, which is literally the same as 100%, it means that at this point 1, price has covered the exact move from this to that. So that's why the best zone to exit is between 0.7 to 1. If you want to be very safe, you might want to exit at point 0.7. If you are certain that the price could go even higher, depending on other tools of analysis that you've used, you could then target the 1 level. So now let's see how you could have placed your stop loss and take profit. So let's say you got into your trade with this entry candlestick, this long candlestick here, after it had closed, of course. So your stop loss will be something like 20 pips, which is here below. If you put it further, about 25 pips. So now the problem has been the target, right? So you already know that the best zone to exit is the 0.7 to 0.1. So if you put your target at 0.7, price eventually hit the zone. And here you had a risk reward of 1 to 2.85 because you risked 25 pips to make 71 pips. So if you also put your take profit at the 1 level, you had a risk reward of, let me just remove this. You had a risk reward of 1 to 3.95 because you risked 25 pips to make 99 pips. That's how you find suitable exit points using the Fibonacci extension. Though I'll advise that you normalize using the 0.7 level, because most of the time you might be very ambitious and target this 1 level and price never gets to the 1 level. So you might just as well target the 0.7 level because it's still a good risk reward of 1 to 2, which is quite good. Of course, also depending on the move. If you have a very previous, if you have a previous impulse move that was quite huge, you would find that your risk reward would even be higher. So you'd have a risk reward of even 1 to 3 or 1 to 4. Basically, that's how you use the Fibonacci extension to find suitable exit points. And remember, this only applies in a trending market. A final example on an uptrend to just make sure you understand the concept. So this is the idea is the market is clearly in an uptrend. We can mark the higher highs and higher lows. We have the series of continued impulse move and retracements forming over time. So after knowing that the market is in an uptrend, we want to find a trade anywhere. So let's assume, I'm not going to the analysis of getting the trade. I just want you to get the concept for now. Let's assume you got into your buy trade after this long candlestick closed. So this long candlestick is a sign of strong bullish momentum. So I'm assuming that after it closed, this is where you got your buy entry. And the question is, how far do you want the price to push to so that you can know the best exit point? Use the Fibonacci extension tool. It has 3 points. You join using the previous impulse. So you must use the immediate impulse move. Someone might wonder, why are we not drawing all the way from down here, but we are using the previous impulse move because we're in a series of higher highs and higher lows. So we're using the immediate impulse move, which is from this point we take the previous higher low, we join to the next higher high, and the third point is where the retracement ended. The third point is not where our entry point is. This Fibonacci tool is only subject to the direction of the trend. So the third point is exactly the next higher low where the retracement ended. So you could put it there and just drag it further to the right for clear perspective. It won't affect the values as long as this line is touching the this higher low. So our exit point, we are targeting the 0.7 level. Price could go the way to 1 or even above, but if you want to be very safe, most of the time target the 0.7 level. So this is where we got into a buy trade. Stop loss will be below this long candlestick, which is about 22 pips, and our target is exactly at the 0.7 level. So if you remove this, you can clearly see that our TP was hit. We had a risk reward of 1 to 3. We risked 22 pips to make 64 pips. So that's how we use it. Let's go to our downtrend. This is the DSD now in a downtrend. So let's assume at this particular point we had an entry. Let me just remove that. Let's assume after this long bearish candlestick, since it's in a downtrend, we're looking for a sell entry. So we have a sell entry at this particular point. So when you get into your sell entry, you can easily put your stop loss somewhere above this high, which is about 30 pips where we had the candlestick close. So price moved all the way to about 100 pips, but at the time of entry, you are not in a position to know how far the price will go. Let's be realistic. And there are times that you're going to target these 100 pips, and then price will only go to 70 pips, and then it uh, forms a complete reversal, and then it ends up frustrating you. So how do you know the best exit point? Same concept, so we use the Fibonacci extension tool. First of all, this is the previous impulse move. Remember, this is our entry point. So we want to use the previous impulse move to draw the Fibonacci extension. So the previous impulse move is from this point to this point. Then this is the retracement. Then we have the continuation. So the Fib extension will start from the previous impulse move, which is this point, to the next lower low, to where the retracement ended. Same concept. It doesn't go to where your entry point is. The third point is where the retracement ended. Let me draw it so that you can get a clear picture. So you start from this previous, where the previous impulse move started. You drop it all the way to where the market dropped to this point. Then we had a small retracement there. So at the retracement, you drag it all the way to the side just to get clear perspective. So since this was our entry point, our target should be at least 0.7 and at most the one level. So let's come and see where we'll have placed our take profit. So that's where we got our entry. Our stop loss was above this candlestick, which is about 30 pips. Then after getting our stop loss, our target should be here at the 0.7 level. This could be your target, or at most you can target the one level. So either way, you had a good risk reward of more than 1 to 1.5, depending with where you prefer to put your exit. But basically, that is how you use the Fibonacci extension tool. It takes more practice for you to be able to apply it. But the key concept is that the market must be in a clear trend. So you must identify either an uptrend or a downtrend. If you cannot spot either of the two, then that's not the right time to apply this tool. So that's it for this video.